Yeah, Morgan, the risks are absolutely mounting. As I've said before, though, and as we discuss in our investment committee, it's often much easier to list the negative risks and the negative potential catalysts than it is those on the positive side of the ledger. So while we feel like there are many short-term risks ahead as we go in the months and the quarter ahead, we think the backdrop is relatively constructive if you're able to extend your time horizon out 9 to 12 months. We see consumers still flush with cash. Businesses are sitting on a tremendous amount of cash that we think will be deployed into CapEx, as well as buybacks and dividends. So we think if you're able to look out past what we see as, particularly in Washington, some lower probability but potentially high impact risk events, we think the outlook is constructive.
Yeah, Joseph, I'll put the same question to you, especially given the fact that, just to put some context around the pullback we have seen in recent days in stocks. I mean, the Dow's only down something like 3.7% from its mid-August peak. The S&P 500 about 4%. The Nasdaq has been the underperformer. It's down something like 5% right now. But it's been quite a while, despite the dramatic moves of recent days. It's been quite a while since we've seen something more significant in this market, what some might even call a buying opportunity.
So certainly the markets have had the long-expected modest correction, I guess, given a confluence of factors that came, as we moved into September and October. But I think the underlying foundations, though, are constructive. You're seeing COVID cases roll over, so that trend seems to be quite meaningful, and I think that should give everyone confidence that that reopening and the improvement in the economic activity should occur. Of course, you have that mitigated by supply chain challenges, and that's one of the things we worry about in the near term, which is while an inventory rebuild you would expect to help economic growth in the fourth quarter of this year, that may be pushed out a bit because of that supply chain disruption. But as you look past that, we remain constructive on the sort of that 1 to 3 year time horizon for the equity asset class.
Joe, how concerned are you about the various goings-on in Washington, whether it's the debt ceiling, government funding, or even debate over both the infrastructure bill and the human infrastructure bill?
Well, I think it really adds to the headwinds, David. Certainly on the tax front, from a corporate tax rate or a capital gains tax rate increase, those are things that the markets are watching very, very closely. And one of the challenges that you have in this fiscal balance, if you will, is it's very modest, right? There's a very small difference between Democrats and Republicans, so 1 or 2 votes will swing whether you're going to see a big corporate tax increase or not. So typically, markets are able to digest that change as policy goes through the system. But here, when you've got that, that very, very slight, balance of power, it's just harder to predict, and markets don't like surprises, as you know.